Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, August 5th, 2019. What we'll do is start out with the monthly charts. As I said recently, when volatility was low, we were in that period of extreme price compression up until recently, and with volatility being low, most of my focus was on the intraday charts, such as a 60-minute time frame. But as I said, don't fall asleep at the wheel. From those periods of low volatility usually come the explosive moves. It's like a coiled spring, and that's exactly what we've had. So now, as I said, I'm going to turn my focus a little bit more so to the longer term charts. So we'll start here with the monthly chart of QQQ. This is painting the big picture. And what we're looking at here, I'll zoom in a little bit. This is the bull market. The QQQ and the NASDAQ 100, which it tracks, bottomed back in November of 2008. Every other index, the Dow, the small caps, mid caps, the S&P 500, all bottomed right here in March of 09. But you still have a reaction, the bottom of that candle there. So there's your bull market uptrend line. It's nice and clean. That's what I like about it. A lot of reactions back here, a lot of reactions picking up here in 2015, 2016, and then most recently. So as you can see, we had a near breakdown right there back in December. We actually closed below it, but just by a relatively small margin, and then we popped up and regained it the next month. And now you can see the month is young. I'm going to say that right now. This is the candle we're working on, the August candle, but it's only August 5th, so we have plenty of time left in this month. Now that's going to go one of two ways, but a couple things I want to point out for you here. So let's start out pointing out the divergence right here. This negative divergence, you don't get this often on monthly charts, and that paints a very long-term picture. These are monthly candles. These are divergences that take, usually years. In this case, it has been a couple years building. And more also, just as, if not more importantly, you have this trend line. Now, this trend line hasn't broken. These are my longest term charts. I don't really go, you can look at yearly charts where every candle's a year, but this is about as far out as I go. And so I'm looking for this trend line as well as this blue line here. It's the dotted line. It's the 20-month exponential moving average, and it just does a bang up job, as you can see here, of defining bull and bear markets. This was the great bull. Up until this bull market, this was the longest and strongest bull market in history ever, and this one recently took that record. But as you can see, just did a bang up job. When you want to pay attention is where the monthly candles close. You'll see a lot of reactions, but as long as you close back above it. So that said, long and strong during the bull market, but right there it broke, and then that line becomes resistance, and you trade below it. This was a new bull market right here. It started in 2002. This is a long-term trend indicator. So the thing about this, it's not going to get you in and out at the top and the bottom, but it will help define the larger trend, and something I've covered in many of these videos. Here's the bull market from 02 to 07. That was our last bull market top, and you can see on the pullbacks, look, a couple minor little whipsaws below, it did just a great job of defining the bull and bear market. We had a, that was it. It broke right there, kicked back, and there most of the bulk, especially the big drop in the market, we were well below it. Regained it here, and again, this is our current bull market, so you can see just a phenomenal job. And again, monthly candles, if you're trading, all that matters are the monthly close, the body, the fat part. These skinny parts are called the shadows of the candle, and on the bottom it's a tail, on the top it's a wick. That doesn't matter. That can go down through as long as it closes. Now, it does come into play in looking at things like trend lines, but you can see back there, look how well that 20-month EMA did a good job of acting as support. And here we had a little whipsaw, regained it. So those are the things I'm watching, and I like the fact that they come in together. If we break this trend line, and we break, or I should say, if we close below the 20-month EMA, we're going to close below the trend line. There's just no way not to, because the 20, and as I like to say, the redder the better. So, well, this month isn't over, but if we get a candle like this, closing out the month of August, it's safe to say that we're most likely in the early stages of a new bear market. I still maintain, the S&P barely made a new high, about 4% or so above the highs from 2018. The small caps, mid caps, they didn't. A lot of indexes in many sectors are still well off their highs from 2018. And so again, it's semantics, what you want to say. I mean, obviously the NASDAQ 100 recently put in a new high, so there you have different indexes, different sectors out there. Let's look at SPY on the monthly. There's your bull market trend line. The SPY and every other index bottom in March of 2009. So you come off the bottom. I have the body of that candle right there grabbing, and here's that trend line. So the yellow trend line tells me, if I zoom in a little tighter, here I'll just color code it for you, blue here. So what we have is simply a breakdown, and it wasn't a little weak breakdown. It was a very impulsive breakdown, and we've come in, like I've talked about, we've been back testing the primary bull market trend line from below. So that in itself put the SPY on a sell signal. Each of these have technically been objective short entries or add-ons to an existing long-term short position, and again, we're effectively right around, we made it slightly above that previous high from 2018, and but we are still above. Here's that 20-month. Look at that, just done a great job defining bull and bear markets. In fact, check it out, back in going back to the great bull market in the 90s, you can see just a bang-up job of defining that bull market. Then we were in a bear market, you were below it, bull market. This was a 2002 to 2007 market. When we broke it in 2007, look at that, they went under, came and back tested it, tried to get it on a monthly basis, but closed right back below it, remained below it since this red candle. This was your sell signal, your confirming sell signal back in the month ending January. Back tested there. That was the last chance. That was they backed it up, gave you one last chance, told you we're already in bear market mode here, and then the bottom fell out, and it kept you short throughout most of the certainly during the bulk of that bear market. And since then, it's just done a pretty darn good job of not perfect, especially the early volatile days of the new bull market, but it's done a pretty good job. So those are the levels I'm watching, both the trend lines and that. And what tells me is that they're likely going to break, and same thing that has for a while is everything else in here. It's not just a trend line. It's not just a break of a 20-month EMA, which is still pending, and that's on my longest term chart. But it's this divergent high, 20% drop. I haven't missed any. I'm not trying to selectively point these out. Divergent high, 51% bear market. Divergent high, 57% bear market. Divergent high, 15% drop. Divergent high 1, about a 20% drop. Divergent high 2, it's still yet to come. We're back testing. This tells me that there's a lot more downside to come. ROC, rate of change 12, when that goes red, you're typically in bear market or severe correction mode. We're red once again. So a lot of evidence pointing there. Now let's zoom down to a weekly chart. You can see same thing. Here's our bull market uptrend line, breakdown back test, weekly divergent high. The weekly PPO has made a bearish crossover that confirms this negative divergence. We're moving down. Look at last week's big red bearish candle, almost a bearish engulfing, but that previous candle was just a bit higher. And you know what? One thing I needed to cover, and I forgot on the monthly charts. No, it's on the weeklies. We're on the weeklies. Let's go back to SPY. Sorry, it was the monthlies. If I didn't cover this a second ago, I meant to. Look at these dojis. These are beautiful. Dojis are not sell signals. You can get them sometimes in an uptrend, and you want to ignore them. But they can often serve as reversal sticks at a bottom or a top. So when you get them during, after a correction or during a correction, they don't mean anything. Just ignore them. They're not going to give you. You're not using a reversal stick. You need a trend to reverse. So you look for them after a prolonged uptrend. Here's one, but it came after a correction, so really it's not at a top. This one came at a top, so at that point there was a heads up right there. Doji on the monthly. Now you need a confirming stick. A confirming stick means not a green stick, a red stick, and like I like to say, the redder the better. We got that. That marked the high. There was the top back in around October, early October, so 2018, and that was the biggest drop throughout this entire bull market since the 2009 lows. That signaled the biggest correction, and there was your confirming candle after the doji. Last month we had, once again, a doji right here. You can see it. And so far, now this month is far from over. It's only the 5th. We have a lot of trading to go. But as I said, the redder the better. So I'll be looking for that. Do we close lower? Do we print a doji, a red doji this month and confirm that? If so, that's another check mark for the bearish case. And then from there, I tried to draw a check mark. That didn't work, but you can see what I'm saying. So the next thing would be a break and solid close below that 20-month exponential moving average, and then of course the trend line as well. We've already back tested the trend line. There's nothing else there other than to see an impulsive rejection, a big red candle, and that will confirm the rejection off the back test. Because that's what I say. The problem with back testing trend lines, whether it's from above or below, is a back test can happen for a while before you finally reverse. But you want to look for that impulsive rejection, whether it comes on the first back test or subsequent. So those are things I'm looking for on the longer term chart that will increase the odds to me that a new bear market is underway and the bull market's over. So we don't have all those yet. We have some of the sell signals here, the breakdown and back test, but we're still pending some others that I just showed you. Weekly chart, same thing I just showed you. Divergence, trend line break, not much more to talk about there. What I will show you is the 40-week moving average. This is the 40-period weekly exponential moving average, and it does a pretty good job. It's the same as the 200-day moving average. We'll get to that on the daily charts in a second. So you can see how well it's done a pretty good job. These are corrections, and during a correction you go below it. But during an uptrend in a bull market, when you're above it, that's what you want to see. That's a healthy bull market. It tells you the trend is bullish, and you can buy pullbacks to that level. Okay, and now you can see that's what we hit today. Let me show you that on the daily chart. Well, before we do that, we'll look at QQQ. Same thing. So again, this is a weekly chart, so we're looking at the 40-period EMA. It's the same as a 200-day because there's 5 trading days in a week. 5 times 40 equals 200. So when you move to a daily chart, it's a 200-day exponential moving average. It's a simple moving average some traders use, and I keep them both on my daily charts, but I prefer this one, especially on tech indexes or tech stocks. What I'm getting at here is very often pullbacks to that level, at least the initial pullbacks. Make no mistake about it, I think we're going to take it out. It's just a matter of, do we bounce first? Usually when you come in and you haven't visited in a while and it's a pretty big drop to get there, that initial kiss of the level, you get a bounce, you get a reaction. And so that's what I'm showing you today, is that the market's closed on support. I'm going to get to a few market leading stocks in a second, then we'll wrap this up. But you can see that quite often, it's those initial pullbacks, especially from a high level. If it takes a while to get there, you're going to bounce on there. And then once you've tapped, you can go through it. And if you break through it, that's pretty bearish. That's what happened there. We, broke it there, and we had a bigger correction. We finally broke it there, and we had a bigger correction. So we could go through it. I'm just pointing out we are the market's hit and reversed off support today. In fact, let's take a look at it on the daily chart. Go here to the daily chart, take away all the lines and drawings. There it is. So there's our 200-day. We overshot it here and then snap back above it in a powerful rally. When sometimes you have those momentum-fueled overshoots, you overshoot a resistance level, the reversal is very impulsive as it was there. Other times you hit it, you sliced through it here slightly, and then you recovered it. You had a bounce on that first correction last fall. And so you can see today we hit it. And I mentioned that in the trading room we were coming up on it, that we hit it and we reversed. So that led for a little bounce trade off there. The big question is, what happens tomorrow? Do we undercut it? I favor a bounce. But I favored a bounce off these levels last week, and this is showing me the nature of this market, that we did have actually a reaction. I should clarify it. Those support levels, we had small bounces, small reaction, but then we kept going. So there's the 200-day. We're also rallied right back below this uptrend line on QQQ off the lows here, and so right now we closed between a rock and a hard place. We did hammer off the 200-day, or reversed, I should say. But there's support. This is about the 182 level right there. We're below that with my next decent price support at 178. So we're about right in the middle there. 182 at resistance above and 178. So my guess tomorrow is that this will hold. We come in back test. That's going to be your first resistance level. That would be a very minor, shallow bounce from, let's see, today's lows. That would be all the way up about 1.6% to come in and back test the 182 resistance level plus that uptrend line. Other natural bounce targets, if you're looking where to trade, if you are trying to game a bounce, if you covered any shorts, you want to recycle back in, or if you want to get short. Here's our gap. So there's the gap today. The bottom of the gap, which is today's highs, would be the first logical resistance level. If we enter the gap, then maybe we backfill the gap. The next resistance would come in there at the Friday's lows, right there on that candle, which is about 186.21. And on SPY, similar story here. There's the 200-day moving average, exponential moving average. We overshot it on a momentum-fueled overshoot to close right back on it. You can see the bottom of that today's candle is just right on it. And so the logical levels too would be the top or bottom of today's gap, either one. And if I put back on the lines, you can see that that would come in nicely. Here's that trend line off the lows from December 24th right here. You have the uptrend line. Remember, we had a minor reaction on it on Friday. Bounce. So should we bounce, that would also be a logical target because it would come in right around the top of today's gap. That's a logical resistance level with 294 right above it. So in other words, if we do bounce, there's going to be an objective shorting op if we happen to get up in that level to get another short again. We may not get it because this has trapped a lot of people in these impulsive breakdowns. What they do is they deny what I call wannabe shorts. Those that want to short, they're looking at bearish, but they just haven't pulled, they don't want to pull the trigger. They don't see the reason until the trend has changed. And this smokes trend chasers, say buy the dip, the trend is up. So what happens, a lot of longs get trapped at a high like this. And now we had the failed breakout of the all-time highs, that breakout above 294. That's clearly a false breakout or bull trap, sorry. And so I'll tell you, there are going to be a lot of trap longs looking to get out on a bounce. This bounce should, in my opinion, be contained by around that 294-ish level max. If it goes much above there, then maybe something else is going on. But right now in the charts, I'll make no mistake about it, I think that there's more downside to come, and these are the targets I've had, earlier in the year, and I think that's still a minimum target down here, about 269 and change, almost 270 we'll call it. QQQ, same levels. I already told you, 182 to 178 support levels. And then finally, I want to show you one more thing. The market leading stocks. Here's Microsoft. I'm going to show you that these are what I call the FANG stocks, FAAMG. I don't use FANG because Netflix never was and never probably, in my opinion, will be one of the top largest components. It's way down the list. It doesn't even, hardly, it moves the needle a little bit, but hardly compared to so I use FAAMG. Facebook, Apple, Amazon, Microsoft, and Alphabet, which is GOOG. So on Microsoft, let's start here. This is the world's largest company, the largest component of the NASDAQ 100, also top component of the S&P 500. There's your breakout. This is comparable to that breakout to new highs that we had in the S&P 500. You can see back here, Microsoft tried at that 130.50-ish level, failed. Tried again, failed. Tried here and it broke out. So right now we still have a successful backtest. It came and hit that level today almost perfectly, as well as this uptrend line. So we had intersecting support levels that Microsoft hit. It hit its uptrend line off the December 24th lows, and it backtested that key 130.50-ish level. So here's, the strongest two of the FANGs. This one, held up the best. It's, all-time highs recently. Unlike a lot of the others, that's a pretty important support level. So again, if the buyers are going to step in, this is where they should do it. This is where I would do it if I were bullish, looking for a move to new highs. Like I said, I have different positions. I'm confuse you when I'll say I'm reversed here, long here, short. My trading account, I'm long into a bounce. I'm going to in futures, I'll stop out if they futures reverse and drop hard overnight. But my swing accounts, I have core short positions that I'm only looking to add to on a bounce back here. Those will sit tight on. So those are swing shorts. So I be clear, I do think Microsoft takes that level out. It's just that I favor a bounce before then. And if it doesn't bounce, again, it's just going to tell me a little more of the nature of this market, saying things are really broken, and we may start, have a much more powerful move down that might take Microsoft all the way down here or here. These are targets that I believe will be hit. I don't want to go into too much analysis on individual stocks here, but I'm just want to make the point that if the market leaders, these are the top weighted components that make up the bulk of the returns of the NASDAQ 100, if they're all at support, which a lot of them are. Apple, I have support at 192.72-ish right there. There's a gap and a reaction there, some reactions there, a lot of reactions there, a lot of bearish technical events on here. So again, I'm just looking at where is this next counter trend bounce going to come. But we had the earnings fake breakout, false breakout, tried to pop the 216 level, which was this previous topping pattern here. Very important level. When that broke, that opened the waterfall sell-off down into the December 24th lows. We came back up to test that. It was very important support right here, which once broken becomes resistance. Failed there. Failed here, but even worse, we failed after a breakout, so that's a bull trap, failed breakout. Then we failed to break out above this downtrend line, both. Well, the uptrend line right here broke, and this downtrend line, you had a breakout above that failed as well. So that's a lot of bearish technical developments, very clearly bearish technical developments in just a few days on Apple. And you can see from the selling there, it just caught all those that drank the Kool-Aid, and bought into after the earnings report have now are underwater. And this is how technical analysis works. I'm sorry, I don't mean to be callous if you bought Apple. I shouldn't say it that way, but it speaks to how technical analysis works. Remorseful buyers that are regretting stepping in then, and they want out, so they're going to use not everybody, I'm generally speaking, the first bounce back into resistance to get out. And that's why any bounce will probably be limited, I think, at this point. Again, in the markets, to about 2-3% would be my guess. But again, I'll assess it as it comes, and then I see more downside in Apple to come from there. All right, a few more, and just to again make the point that a lot of these are at support. Amazon, AMZN, 1752. I've had this level on my chart for ages. In fact, it was my first price target all the way back here last year when this wedge broke. Beautiful. Look at that divergent high. T1, I believe that was the T1 here was actually I must have moved those lines. It says T2 zone. Either way, I can tell you that was that's a good resistance level. Was a resistance, support, support, resistance, resistance, support, resistance right there. We whipsawed through it there, but again, it's a level that had a lot of reactions in the past. Not the most solid level, and Amazon also dropped below the 200 today. Sometimes some stocks will do that. And again, I take these collectively, not at what any one stock is doing, but what's the group doing? What are the market leading stocks all doing? Are they, most of them at or near support? And that's the case right now. Here's an uptrend line on Alphabet. That's GOGL, Class A shares. We have the gap right here, big earnings gap. That's where we closed before earnings. This is the gap up right there, this candle. So now we've backfilled the gap, and we've hit this fairly well-defined uptrend line. So that's support. Again, this is where, quote unquote, the market should bounce, and these stocks should bounce. If they don't, something is really broken in this market, and we're probably going a lot lower. All right, a couple more. There's the other share class, GOG. You can see the trend line a little more clearly, 200-day coming up. Here's Facebook, similar uptrend line coming off the lows on December 24th as support. And I had support here. Again, these are levels I've had here for a while, about 182 roughly. It says 185, 181.95. It's just been a level for a long time that traders have, stepped in and bought and sold the stock off of, and that's about where we closed today. I'll end it here with JP Morgan. This is one of the largest, it is the largest bank, largest financial institution. And the NASDAQ 100, as I always say, half jokingly, it's really just it's a tech fund with an Amazon kicker. Why? Because it lacks a lot of different important sectors in the economy, such as financials. It doesn't have any banks or financial stocks in there. So look at, the S&P 500, this is a top weighted component. JP Morgan, And again, just another one of the market leading top weighted components. There's that uptrend line from the lows. We hit that, and you can see the red line there. Hit the 200-day, closed, overshot both on a momentum fueled overshoot. When you look closely, you see the candle, but look, we parked right on there. So I have the majority, most if not all, the market leading stocks closing on pretty significant supports, and therefore this is where the market should bounce. So I favor one tomorrow, but make no mistake about it. The charts tell me, just like we had a divergent high here, here, and here, those divergent highs led to this drop, and so far only this. And by the way, only this, has so far started out with a bang, much more impulsively than even this one, which was pretty impulsive, and certainly more impulsive here. So that tells me that, to me, it's a matter of, we bounce here and then break that line, but we're most likely going lower. So I'm going to end it here, and I'll say what I always say: support is support until and unless broken. So here's the level we're at, and both on the major indexes and a lot of these stocks. So we'll probably get a bounce here tomorrow, but if we don't, then things can be very ugly. So that's the hard part about trading, is that you have to adapt. If you're trying to game that bounce, whether you go in long, the safer bet is to wait till tomorrow and see if the futures hold up if you're only an ETF trader. If you trade futures, no problem. You can go long NQ or ES now, and you can set a stop loss order. There's so much liquidity that you can use market orders, regular stop loss that converts to a market order, and get filled at a good price overnight if the trade moves against you. You go long or go home QQQ or SPY tonight. Whatever happens overnight, we're probably going to gap up or down. And so if we gap up too much, like I said, we gap up 1-2%, well, that's probably a half or all of the move I'm looking for the bounce back. So you might not want to chase that. And of course, if you gap down, we're going to gap down, especially if we take out today's lows on the indexes and a lot of these major stocks, we're going to have broken a pretty good support. Those were broken intraday, but that was fine because we rallied back up to park and close on them. But if we go down below them again tomorrow, not good. So we'll wrap it up here, and I'll pick things up tomorrow. This has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.